Texts. There's a phone call that millions of Americans celebrate every year. It is the call from a bank, a credit card company, or a collection agency telling them that their debt has been forgiven. You owed $15,000. They agreed to settle for $5,000. The remaining $10,000 is wiped clean. You feel the weight lift, the calls stop, the letters stop. You think it is over. And then, sometime between January and March of the following year, an envelope arrives from the IRS. Inside is a form you have never seen before. IRS Form 1099-C, Cancellation of Debt. And next to the box, labeled amount of debt canceled, is the number $10,000. That $10,000 is no longer a debt to the bank. It is now income, taxable income. And the IRS expects you to pay taxes on it as if you earned it, because under United States tax law, you did. The debt settlement industry generates over $3 billion in annual fees. It promises consumers relief, freedom, and a fresh start. What it rarely discloses is that the fresh start comes with a tax bill. In 2022, creditors and lenders filed over 6.3 million forms, 1099-C with the IRS, representing tens of billions of dollars in canceled debt reported as income to consumers who thought their financial nightmare was over. For many, the tax bill on forgiven debt is larger than the monthly payments they were struggling to make in the first place. They escaped one creditor and walked into the arms of another, and this one has the full enforcement power of the federal government. Welcome to the Invisible Ledger. If these stories matter to you, hit subscribe and the bell. This is where we trace the money they told you not to follow. The legal foundation for taxing canceled debt is as old as the modern income tax itself. Under Section 61 of the Internal Revenue Code, gross income means all income from whatever source derived. The Supreme Court established in the 1931 case United States v. Kirby Lumber Company that when a taxpayer purchases their own bonds at less than face value, the difference constitutes taxable income. The principle was extended to all forms of canceled debt. If you owe $10,000 and the creditor agrees to accept $5,000, you have experienced an economic benefit of $10,000. The IRS treats that benefit as income. The reporting trigger is Section 6050P of the Internal Revenue Code. Under this section, any financial institution, credit union, federal government agency, or any organization that has a significant trade or business of lending money that cancels a debt of $600 or more must file Form 1099-C with the IRS and send a copy to the debtor. The form reports the amount of debt canceled, the date of cancellation, and whether the debtor was personally liable. The $600 threshold is remarkably low. A negotiated reduction on a medical bill, a settled credit card balance, a forgiven personal loan, or even a short sale on a mortgage can all trigger a 1099-C. The mathematics of this trap are devastating for people who think they have saved money through settlement. Consider a consumer who owes $30,000 on a credit card. They are in financial distress and hire a debt settlement company. The company negotiates the balance down to $12,000. The consumer pays $12,000 to the creditor and $2,400 to the settlement company in fees, approximately 8%, which is typical in the industry. The consumer believes they saved $15,600. Then the 1099-C arrives. The $18,000 in canceled debt is added to their taxable income. If they are in the 22% federal bracket, the federal tax on that canceled amount is $3,960. Add state income tax, and the total can exceed $5,000. The consumer's actual savings are now approximately $10,600, not $15,600. And the tax bill arrives as a lump sum, due in full by the April filing deadline. For someone who was already in financial distress, this can be catastrophic. The debt settlement industry is regulated by the Federal Trade Commission under the Telemarketing Sales Rule, amended in 2010, which prohibits settlement companies from charging fees before they have actually settled a debt. But the rule does not require settlement companies to clearly disclose the tax consequences of settlement. Most consumers learn about Form 1099-C only when it arrives in their mailbox. The CFPB has received thousands of complaints about debt settlement companies that failed to explain the tax implications. But no federal regulation currently mandates that settlement companies provide a written tax disclosure before enrollment. Before I go further, this video is just the surface. Inside the Invisible Ledger Vault, you will find the complete guide to 1099-C defense strategies, IRS Form 982 walkthrough, insolvency calculation worksheets, state tax conformity charts for canceled debt, and comparison tables showing settlement versus other options with full after-tax analysis. The link is in the description, but stay right here. Now here is what the industry does not want you to know. There are legal exclusions that can eliminate or reduce the tax on canceled debt. The most powerful is the Insolvency Exclusion under Section 108A(1)(b) of the Internal Revenue Code. Under this provision, if you were insolvent at the time the debt was canceled, meaning your total liabilities exceeded your total assets, the canceled debt is excluded from gross income up to the amount of your insolvency. If you owed $200,000 in total debts in your total assets, including everything you own, bank accounts, car, equity in your home, retirement accounts, personal property, were worth $150,000, you were insolvent by $50,000. If $18,000 in debt was canceled, the entire $18,000 is excluded because your insolvency exceeded the canceled amount. To claim this exclusion, you file IRS Form 982, Reduction of Tax Attributes, due to discharge of indebtedness with your tax return. The form requires you to calculate your total liabilities and total assets immediately before the cancellation event. The IRS provides instructions and worksheets for this calculation in Publication 4681, Canceled Debts, Foreclosures, Repossessions, and Abandonments. Other exclusions exist as well. Under Section 108A, 1A, debt canceled in a Title 11 bankruptcy proceeding is fully excluded from income. The Mortgage Forgiveness Debt Relief Act, originally passed in 2007 and extended multiple times through subsequent legislation, excluded qualified principal residence indebtedness from income for debts discharged through 2025 under certain conditions, with the exclusion amount capped at $750,000 for single filers. Additionally, student loan discharges under certain public service or income-driven repayment programs are excluded from income under the American Rescue Plan Act through 2025. If you have made it this far, you understand the 1099-C system better than the vast majority of Americans who will settle debts this year without understanding the tax consequences. Subscribe and share this video. Here's what you need to do. Step 1. Before settling any debt, calculate the tax impact. Determine your marginal federal and state tax rate and multiply it by the amount that will be canceled. This is your potential tax bill. Add it to the settlement amount and the settlement company's fees. That is your true cost of settlement. Step 2. Determine whether you qualify for the insolvency exclusion. List all of your liabilities, everything you owe, including mortgages, car loans, student loans, credit cards, medical bills, personal loans, and taxes owed. List all of your assets, including bank account balances, investment accounts, retirement accounts, home equity, vehicle value, and personal property. If liabilities exceed assets, you are insolvent, and you may be able to exclude some or all of the canceled debt from income. Step 3. If you settle and receive a 1099-C, do not ignore it. File Form 982 with your tax return if you qualify for the insolvency exclusion or any other exclusion. Step 4. Consider alternatives to settlement that avoid the 1099-C entirely. Paying the debt in full over time through a negotiated payment plan does not trigger a 1099-C. Bankruptcy eliminates the tax liability entirely since debt discharged in bankruptcy is excluded from income under Section 108. A hardship program with the original creditor that reduces interest but does not reduce principal does not trigger a 1099-C. Step 5. If you hire a debt settlement company, demand a written disclosure of the tax consequences before enrolling. Ask them specifically about Form 1099-C, the insolvency exclusion, and Form 982. If they cannot answer these questions, do not hire them. Step 6. Consult a tax professional before finalizing any settlement above $600. A qualified CPA can run the numbers and determine whether the settlement actually saves you money after taxes. The total cost of understanding the system is zero. The total cost of ignoring it is a tax bill you never expected on income you never received. I need to be honest with you. This is not an argument against ever settling a debt. There are situations where settlement is the best available option. First, if you are insolvent and can claim the exclusion on Form 982, the tax impact may be zero or minimal, making settlement genuinely beneficial. Second, the emotional and psychological toll of carrying overwhelming debt has real costs that cannot be measured in tax dollars alone. Third, creditors do not always issue 1099-Cs. While they are legally required to for cancellations above $600, some creditors fail to file, and if no 1099-C is issued, the IRS may not be aware of the cancellation. However, relying on a creditor's failure to file is not a legal defense. Fourth, the insolvency calculation can be complex. Retirement accounts, for example, are counted differently depending on whether they are protected from creditors under state law. Getting the calculation wrong can result in an IRS adjustment and penalties. And fifth, tax law around debt cancellation changes. The mortgage forgiveness exclusion has been extended multiple times but is not permanent. Future legislation could expand or narrow the available exclusions. Your grandparents understood that there is no such thing as free money. When someone forgives what you owe, something is always exchanged. For centuries, debt forgiveness was an act of mercy, a jubilee, a fresh start with no strings attached. Then one generation built a tax code that turned mercy into revenue. The The forgiveness was not free. It was reclassified. There was not a gift. There was a transaction. And the only party that never loses in a transaction between a debtor and a creditor is the one who taxes both sides. Subscribe and share this video. Every share warns someone about the envelope they are not expecting. The next vault opens soon, and what is inside will reveal the single document that every American should file before their next tax return, one that most accountants have never mentioned because it would cost them a client.